All right, let's trade some stocks. Nvidia's up this morning. Palantir, too, about 3% each. Apple's sticking out like a sore thumb right now, but markets are generally firm. Tom White's here with me in studio looking at options. Paul McCarthy joins us, president at Kisco Capital, to talk some stocks. Paul, you like one of these more than the other? We're going to talk Nvidia and Palantir, both big winners last year, of course, but kind of kicked in the thrusters at different times.
Yeah, I mean, I think, when I look at the two, NVIDIA is kind of almost, as it's grown its revenues, like grown into its valuation metrics. But when you look at Palantir, it's had a really big screaming move higher in the stock price. But you're talking about a company that does around $3 billion in revenue, and its market cap is $170 billion. They have a big chunk of the revenues that come from the government. So, maybe the Trump administration has a big fat contract coming down the pipeline. But I think that in order to grow into their valuation, they really need to show some big traction, probably on the private sector business that they have, next year. And it seems like, I think for next quarter, they got it to like 770 million. But, they really need to start putting up quarters where they're doing over $1 billion in revenue. So I think that when I look at the Palantir stock, there's, really needs to prove itself that it can handle pullbacks at this high level that it's trading at. Otherwise, you could just have a spike in reversal if they really don't follow through next year on the fundamentals. So I definitely like NVIDIA from that perspective better. I think it's got a really nice chart pattern as well. But, the Palantir stock, I think, is more risk for a reversal lower. I could easily see the stock getting down below $60 on just your normal everyday pullback, given how much higher the stock has gone. So I'm more cautious on the Palantir than Nvidia.
RSI 80.6 that you've got on your chart there. That is pretty hot. Doesn't look like too much sign of it rolling over, but it has got a little choppy up here at $80, Tom. I think there's some premium here, though, too, from the politics, right, where people just go, Peter Thiel's old gig is going to get all the government contracts now in a Trump world, basically.
Yeah, implied volatility levels, even though we were up 340% last year, they continue to move higher just due to the fact that the call skew gets a little steeper up there as people reach for upside calls and exposure in Palantir. So I did something a little bit of contrarian here to take advantage of that high implied volatility. Okay. I think it's going to maybe top out. Maybe it's going to pull back a little bit.
So it's kind of in Paul's point.
January 17th monthly cycle. So just a really short-term positioning. And then you can do this type of strategy repeatedly based on where you think a stock's going to be, right? To collect credits and take advantage of that high IV. So going out to that January 17th monthly cycle, sell the 79 call, but I want to stay risk-defined. So I'll buy the 82 strike call, 79 call, 82 call vertical, $3 wide, collecting roughly about a 90-cent credit. That's what I can make on that trade. Got $210 in risk on it, but I've got that cushion to the upside where that break even's just below $80.
Because you're buying the 82?
Yeah, because you're buying the 82.
Okay.
You got to stay risk defined in this name just because of the parabolic moves that you can see on a daily basis on something like this. But if you own the shares, this is a great way to offset maybe some risk to the downside, create some yield on your position, or if you're just speculating to the downside where, hey, it's run up too far too fast, maybe it consolidates or pull back.
Okay. I like it. Sell the 79, buy the 82.
Yeah.
Bet on Palantir cooling off a little bit.
Yeah.
When you look at the chart for NVIDIA, Paul, is hot? What do you see?
Yeah, I mean, when you look at, I like to look at the weekly chart, but when you look at the weekly chart, when you look at the RSI, there's definitely a negative RSI building. The MACD's kind of peaked out back in, July. But the stock has kind of traded higher. So, and like I said, this looks like it's got a nice Elliott wave, 5-wave pattern unfolding. I think it's still got some more upside left, maybe up into the 172 area. But I do think that you may see 2025 this year where you do see some consolidation in the stock, maybe around in the 110 to 130 area. That doesn't mean that I don't think they're going to stop being dominant, but any stock, it exhausts and has to rest at some point. So, I would I would look at this as like, I do think it's a good spot to, if you don't have a position near a trader, to initiate a position But like I said, I still think the stock has more upside left.
All right. Like the charts, like the analysis. Thanks, Paul. Good perspective there. Price looking pretty solid still with the uptrend, but that bearish divergence, bit daunting. What's the approach, you think, Tom?
Well, you look at the implied volatility levels. It started to at least consolidate above 130. It's made its way back up above 140 again also. IV percentile rank of about 24%, so in the lower 1/4 of where implied volatility levels are over the last 52 weeks. So what type of strategy works to the upside in that? Well, I looked at a call vertical where I can offset some of my risk on this position that's bullish. So looked at the January 31st weekly cycle. So I've got just about 28 days in this position, about a month. Avoids earnings that come later on in February. But it takes advantage of upside where I'm going to buy the 140 strike call. And then against it, I'm going to sell the 152.5 strike call. So a bullish $12.5 wide call vertical to the upside. Paying roughly about, I've got a $5 debit here on my risk profile, but I think it's trading closer to $5.40 now. The stock has continued to move higher. But if you pay a $5 debit for it, that's your risk, $500. That can expand to $12.5 if it goes back to those all-time highs of about 152.5. Here. So you got a good risk reward setup. The break even, if you pay $5, going to be 145. That's less than 2% above the current share price in Nvidia. So taking that directional bias while offsetting some of the costs on it, because if you just buy the 140 strike call, you got a lot of extrinsic option premium in that, where it takes that break even to the upside where you need to go for profitability up a little bit higher. By selling the 152.5 call against it, you're lowering that break even and your risk on this position.
All right, so you're using the vertical again, but you're owning it this time. Buying it, owning it.
Because of the low implied volatility level.
Because it's cheaper.
Yeah.
Yep. All right, fair enough. Because, that really is the main difference between the two, is that the one's a lot more volatile. So, all right, makes sense. Okay, thanks, Tom. Thanks, Paul McCarthy as well, Kisco Capital.